Good day, everyone. The third quarter of 2025 saw global financial markets post strong gains, driven by robust artificial intelligence and technology demand, solid corporate earnings, and a well-anticipated Federal Reserve rate cut. Although U.S. trade policy wasn't in the spotlight as much as earlier in the year, some progress was made and there's still a lot of uncertainty. Businesses around the world are changing how they manage their supply chains to rely less on the US and China, which has been at the center of recent trade disputes. Even though markets perform well, there are still risks. Valuations are high, inflation remains a concern, and global political tensions could still affect market stability. US stocks had a strong third quarter, with the S&P 500 rising by 8% in USD terms, significantly ahead of cash. There were a few bumps along the way, especially after the July jobs report and a sell-off in government bonds in September. Inflation in the US ticked up slightly in August, but the impact of the new tariffs was less severe than expected. This gave the Federal Reserve room to cut interest rates by 25 basis points in September, its first rate cut of the year, and it signaled that more cuts could follow, which gave further support to US equities. Developed market equities, as measured by the MSCI All Country World Index, ended up the quarter up 7.3% in USD terms and 4.1% in rand terms, as a strengthening rand detracted from the returns of global asset classes. A general risk-on environment caused emerging market equities to outperform developed markets during the quarter, up 10.6% in USD terms and 7.4% in rand terms. The strong performance was mainly driven by big players like China, Taiwan, and Korea. The progress in the US-China trade talks helped boost investor confidence, while continued excitement around AI-related companies also added to positive momentum. Bond markets were volatile throughout the quarter as a global political uncertainty and concerns around fiscal sustainability came into focus. Nonetheless, the FTSE World Government Bond Index eked out a positive return, up 0.6% in USD terms and down minus 2.6% in rand terms, mainly supported by the US Treasuries. European and UK bonds ended the quarter marginally down. Global property had another positive quarter, up 4.2% in USD terms and 1.16% in rand terms. Back home, in the midst of rising global uncertainty, governance and accountability took center stage with the ongoing Madlanga Commission. South African equities continued to extend their rally in the third quarter, with the FTSE JSE All Share Index up 12.8%. Strong gold and platinum prices underpinned a buoyant performance from the resources sector, up a staggering 46.8% and a year-to-date return of 105%. Returns from the industrials and financials were much more muted, up 3.7% and 1% respectively. Local property, on the other hand, gained from a falling local bonds, up 5.5%. South African nominal bonds rallied further in the third quarter as the South African Reserve Bank confirmed that the 3% bottom end of the official inflation target range was now their preferred goal. Strong foreign demand was also evident for local bonds in the quarter. The JSE All Bond Index delivered a 6.9% over the quarter and a 14.5% over the past 12 months. Cash was clearly underperforming local asset class in the third quarter as the South African Reserve Bank continued to cut policy rates, though still delivering inflation beating returns of 1.8% over the quarter and 7.8% over the past 12 months. The rand continued its strong run and gained roughly 2.5% against the US dollar, supported by dollar weakness and higher gold prices. Let's take a closer look at the performance of the Focus Multi-Asset Solutions over the past quarter. The strong performance for markets translated into another good quarter for both the momentum-focused model portfolios and the fund of funds. Our overweight position in local equity contributed positively to performance and also helped to offset the impact of strengthening rand that detracted from the performance of global asset classes in the solutions. MFE Focus 3 was up 5.4%, while the 5 and 7 unconstrained model portfolio were up by 7.2%, 7.7%, and 8%. The Momentum Focus Fund of Funds 3, 5, and 7 delivered returns of 6.4%, 7.5%, and 8% for the quarter. Due to the continued strong quarterly performance, the one-year returns for all the funds are comfortably ahead of their benchmark and peer groups. All the funds are now also ahead of their benchmark over their respective time horizon, as well as all other time periods of 3, 5, and 7 years. The MFP Focus model portfolios continue to deliver on their objectives since their launch 54 months ago, with all portfolios ahead of both their benchmark and peer group over the period. Now let's take a closer look at our global managed solutions. All three global managed solutions delivered positive dollar returns during the quarter, ranging from 2.9% for the cautious portfolio, 4.4% for the managed portfolio, and 5% for the gold portfolio for the quarter. Performance was ahead of peers, and this again reinforces the view we've held that the majority of peers are more anchored to US assets. Asset allocation in the funds was positive, in particular our allocation to gold and gold mining shares, which both rose sharply as investors sought alternative forms of protection. Our allocation to Chinese equities was also a positive contributor, following gains of over 20% in dollar terms during the period. Manager selection, on the other hand, was a detractor. In general, active managers struggled in Q3 as momentum swung firmly in favor of large cap, AI-linked companies. It is hard to argue the idea that valuations of some of these AI stocks now look stretched. Nonetheless, it is important that we manage the extent of our underweight to this area, as the use case for AI technology as it develops through further innovation is vast, and therefore it is something we are paying close attention to. Over the 12 months, our funds have returned at 7.6%, 12.4%, and 14.6% respectively in dollar terms. Where do we go from here? Shorter term, we are still of the view that it's right to be cautious. However, we continue to see opportunities outside of the most expensive part of the market, with attractive yields allied in some cases with decent growth prospects. Areas that continue to look attractive to us include asset-backed securities and private lending. Inflation outlook remains all important. If inflation is kept under control, then interest rate cuts can be used to counter any slowdown in global economy. While the US remains exceptional, it is also a reminder that the policy making in the US is likely to remain highly erratic, which has led investors to seek greater diversification in areas like gold and non-dollar assets, a trend that is likely to continue. Please join us for the upcoming Outcome Matters session, where we will discuss the topic in greater detail. That said, staying invested contributes significantly to how successful one will be in reaching your investment objectives. So remain invested. Thank you.